Year-end tax planning for 2013 should not be as complicated as year-end 2012, when we did not know if the Bush tax cuts would be extended for 2013, or if the regularly expiring tax provisions that had expired for 2012 would be extended. At the beginning of 2013, in year-end legislation, the Bush tax cuts were extended for most taxpayers, but some exceptions were made for higher income taxpayers, and most of the regularly expiring provisions were extended for 2012 and 2013. In looking at year-end 2013 planning, tax practitioners should be focused on the impact on higher income taxpayers of the Bush tax cuts that were not extended, the expiring provisions that expire at the end of this year, the tax aspects of the provisions of the Affordable Care Act that have phased in for 2013 and are phasing in for 2014, the IRS recognition of same-sex marriages, plus the regular year-end tax planning opportunities. The fact that key elements of the Bush tax cuts were allowed to expire for higher income taxpayers means that for 2013, the top marginal tax rate increased from 35% to 39.6% for taxpayers with taxable incomes over $400,000 for single filers and $450,000 for joint filers. The top capital gains rate increased from 15% to 20% for those same taxpayers. Also, the phase-out of itemized deductions and exemptions returned in 2013 for taxpayers with adjusted gross incomes in excess of $250,000 for single filers and $300,000 for joint filers. Taxpayers subject to these changes should have been anticipating these increased taxes through higher withholding and estimated tax payments during 2013. The AMT exemption amount was permanently adjusted for inflation, making AMT planning easier. Estate and gift tax rates and exemption amounts were also made permanent, also assisting in planning. The ever-growing list of regularly expiring provisions also expire at the end of 2013. Although they have tended to be fairly reliably extended in the past, even if retroactively, the congressional focus on fundamental tax reform might mean that many of these tax breaks would go away in return for lower tax rates. Although tax reform does not appear likely this year, taxpayers may want to plan for year-end 2013 as if these provisions might not be around next year. Some of the key provisions for individuals expiring after 2013 are the sales tax deduction, the ability for people aged 70 and a half and older to make IRA distributions directly to charity, contributions of capital gain real property for conservation, the exclusion for discharge of principal residence indebtedness, and the credit for energy-efficient home improvements. Some of the key provisions for businesses expiring after 2013 are the 50% bonus depreciation, enhanced Code Section 179 expensing limits, the Work Opportunity Credit, the Research Credit, the 100% exclusion for Code Section 1202 small business stock, the 5-year recognition period for S-corporation built-in gains, and the 15-year recovery period for leasehold, retail improvements, and restaurant property. There are many other individual and business provisions also expiring at the end of 2013 that should be looked at by particular taxpayers. The phase-in of the Affordable Care Act has brought a new 0.9% Medicare contribution tax on earned income over $200,000 for single filers and $250,000 for joint filers, and a new 3.8% Medicare contribution tax on the lesser of net investment income or adjusted gross income in excess of that same $200,000 for single filers and $250,000 for joint filers. Many of these new taxes on higher incomes will reward planning that evens out income from year to year, avoiding spikes. Also for 2013, the Affordable Care Act increased the medical expense deduction threshold to 10% for taxpayers under age 65. Starting in 2014 under the Affordable Care Act, individual taxpayers may be entitled to a new credit to help them pay for health insurance. Individual taxpayers may also be subject to a tax penalty for failure to obtain health insurance. The employer penalty for failure to provide health insurance was postponed to 2015, but employers have new reporting requirements with respect to health care. The Affordable Care Act also put a $2,500 cap on health flexible spending accounts starting in 2013. Tax practitioners can assist their clients in anticipating and preparing for these changes. The Supreme Court's decision in the Windsor case declaring a key section of the Defense of Marriage Act unconstitutional also means that legally married same-sex couples will be required to file tax returns for 2013 either jointly or as married filing separately, rather than single returns as required in the past. The usual planning techniques also apply for year-end 2013, looking for ways to postpone income and accelerate deductions, using your annual gift tax exemption of $14,000 or $28,000 for a couple, maximizing contributions to qualified retirement plans, reviewing investment portfolios for possible realization of capital gains and losses before year end. The resolution of the federal shutdown is only temporary. Another shutdown could affect the IRS responses to taxpayer inquiries and delay preparation of 2013 tax forms and instructions, as well as other guidance. We wish you a successful year-end tax planning season.